Here we have a panel on a very different set of experiences. I would say, let's call them developing or emerging market countries, which have experienced more of a problem with the capital inflows, with kind of a monetary policy challenges which arise from this kind of a setup. And we'll hear the experiences from Turkey, from Israel. But first we'll hear a bit of the overview for the World Bank side. When we talk about the capital flows, one should first ask what did we know about the capital flows. And when I was preparing for the panel, I looked a little bit at the IMF projections of the capital flows in the World Economic Outlooks from 2009 up until now. Judging by the forecasts from the WEOs, we knew almost nothing because they were completely wrong. If you look at the 2009, I looked at the 2009 April WEO forecast, which actually projected that the capital flows to the emerging market countries will decline from the level of 300 billion dollars a year to 20 billion. Actually, they increased to 480 billion in the end of 2010. And when you went through the successive WEOs, they kept on revising, these capital flows to the emerging market countries, but actually every time you look, the outcome was higher than was projected. And if you look at the crisis effect on the capital flows to the emerging market countries, and you take out the 2007 as an outlier, you'll see that actually capital flows to emerging market countries are higher than they were prior to the crisis, and that the composition of those flows has not changed for the worse, that you basically still have approximately 60% debt, 40% equity composition of those flows. So it's a very different, as I said, experience than we've seen in some other countries, of which we've heard in the first panel in the morning. I remember also the last year's annual meetings. We talked about it over the lunch, where people from the emerging markets were basically scared by the QE2 in the US. Everybody afraid that the QE2 will actually lead to large capital inflows to the emerging market countries, and the challenges in managing the real exchange rates and the asset prices. So it will be nice to hear, like a year later, what do you have to say about that? Because at the latest annual meetings, people were scared by other things, so they didn't comment too much on that. So without further ado, I will call Brian, who worked for 25 years with the World Bank, who has a lot of experience also in this part of the world. You were working and living in Poland at the beginning of the transition, as it says in your bio. Also had experience with Russia. To start and give us an overview from the World Bank point. Yeah.
Thank you very much, Boris. First of all, let me express my profound gratitude to the President of the National Bank, Marek Belka, for inviting me to participate in this very distinguished international conference. And second, let me admit that I am the tail risk on this panel because I'm the only inexperienced non-central bank official. So I'm going to give you a slightly broader overview, and I'm going to claim naivete and perhaps be a bit provocative. The main point of my presentation is that economic policy formulation has to go far beyond monetary policy if it wants to maximize the growth benefits of capital flows while minimizing the crisis risks associated with it. And this harkens to the point that Jacob Frenkel was making in the previous session, that you cannot overburden monetary policy. And essentially, the point is that policymakers have to adopt what Joshua Eisenman called self-insurance combined with a public finance approach to managing financial integration and capital mobility. So that is the main point. And the point is that this conclusion actually comes from the very successful response of the emerging markets to their own crises, which took place between 1997 and 2001, starting with East Asia, and then going on to Russia in 1998, Brazil in 1999, and Argentina and Turkey in 2000 and 2001. And so this response, which we call self-insurance plus a public finance approach to financial integration and capital mobility, really captures the response of those countries and eventually underpinned their remarkable resilience during the global crisis of 2008-2009. So finally now, first of all, there are two sets of lessons from financial integration, those which pertain to growth and those which pertain to crises. And there are 4 lessons listed in this slide. I'm not going to go through all of them because you can probably read them much faster. But the point is that fast-growing emerging market countries have tended to finance their own growth and on average to run current account surpluses. Now, there is a study that has recently been, or is being completed at the World Bank by my colleagues in the Europe and Central Asia region, which is called Golden Growth. And this study presents conclusions which suggests that for CESEE, the links between capital flows and growth could be much more positive, and in fact almost unique compared to what we see in other emerging market countries. Capital has flowed downhill, has tended to go to countries which grow faster, and FDI has been a very prominent part of these capital flows. And we know that for financial integration, and that's the 4th result here that you'll see on the slide, the results suggest that if financial integration is to have a positive impact on growth in emerging markets, then it must somehow contrive to raise the level of total factor productivity growth and bridge the gap on total factor productivity between rich and poor countries. And there's really no guarantee that this will normally happen. I don't really have to say much about the links between financial integration and crises, except that we have a number of empirical examples, starting with Diaz Alejandro's famous documentation of the Southern Cone experience. Basically, though, the point that I want to emphasize is that after the emerging market crises of 1997 to 2001, the emerging markets realized that they were on their own. Things like the sovereign debt restructuring mechanism did not take off, nor did the proposal to, let's say, have debt with equity-type features such as GDP index bonds take off. So eventually they realized that they would have to clean up this mess themselves. And that's when they just started building up reserves, but they went far beyond building up reserves, as we shall soon see. The point is that in a way they crossed a threshold, and it's the crossing of this threshold is what made them resilient during the Great Recession. So the question is, what did they do? First of all, in terms of the macroeconomic trilemma, namely the idea that you can choose at most 2 out of the following 3, a fixed exchange rate, interest rates, or independent monetary policy, and an open capital account, they adopted a very pragmatic approach and moved to what we call the middle ground of the macroeconomic trilemma policy space. And that shows up in this graph here, where essentially the closer you are, if you are at 1, for example, the first arrow is directed at directed at exchange rate stability, and essentially countries went from fixed exchange rates to much more flexible exchange rates, and that's what that first arrow tells us, and that's what it's pointing to. And the second is that financial capital account openness increased dramatically, especially after 1990, and monetary policy independence stayed roughly at the same level. So at the margin, you had countries giving up fixed exchange rates while they opted for greater financial integration. Let me just go back to the previous slide. The second is that they accumulated a massive amount of foreign exchange reserves, and there's a graph showing this, but I don't really need to show it. I will come back to it later. And the third point is that they adopted this public finance approach to financial integration. And what does this mean? First, they put their fiscal house in order. in order to create space for tail risks. And here, once again, my own observation is that crises which originate in the public sector tend to be much more serious than those that originate in the private sector. If you look at East Asia in 1997 versus Russia or Argentina, East Asia had a very strong public sector balance sheet and was able to absorb the losses or the contingent liabilities from the private sector and recover very quickly. On the other hand, Russia and Argentina took a much longer time to recover from their crises because these essentially at root had fiscal solvency problems associated with them. And so this is just to say that, the point, this is the second time I'm alluding to a point made by Jacob Frenkel, but in this case, I think that looking at country debt, I would look at it a bit differently in that I do think that there's a lot of evidence now to suggest that crises which originate on the public sector balance sheet tend to be much more difficult to deal with than those that originate on private sector balance sheets for the reasons I had mentioned earlier. The third part of the public finance approach is that central banks have to, of course, adopt macroprudential regulations. And the reason is that you can self-insure by building up reserves. You can self-insure to some extent by having a very strong public sector balance sheet, but you still have moral hazard risks and you still have very costly externalities associated with certain steps that can be taken by the private sector. Two of them that we identify, that Joshua Eisenman and I focus on in particular, are external borrowing surges by banks, which might go far beyond just financing themselves through deposits. And this, of course, is often associated with a bubble in the housing sector. So making dynamic use of loan-to-value ceilings could help to control some of these contingent liabilities. Because if you have a housing bubble that bursts, the external costs associated with it for the huge economy, for the whole economy, are huge. Let me go very quickly over this. I've already been over this. This is the graph on the accumulation of reserves. And this is essentially the so-called self-insurance package, which draws on the 3 generations of crises models and summarizes what the emerging market countries did after their crises of 1997 to 2001. So they essentially restored sustainable public debt dynamics. They took steps to minimize contingent liabilities from the private sector, and they built up reserves. And normally when people talk about self-insurance, they focus just on point 3, but the other 2 points are equally important, in fact, if not more important. So what are the lessons going forward? The first lesson is clearly that if countries want to maximize the growth benefits and minimize the crisis risks from capital flows, they have to go far beyond monetary policy. They cannot, as Jacob Frenkel said, overburden monetary policy. And we already know what this means in terms of the table I just presented, so I'm not going to repeat that. But the last bullet is what I'd like to draw your attention to in this slide, that really there is a case for letting regulation and macroprudential measures evolve dynamically so that they don't stagnate, they don't become something that's routinely looked at and therefore lose their bite. The second set of lessons, and this is where since I'm a non-central bank governor and I can afford to be a bit naive, is that in the past, there's a view out there that capital controls don't work, that macroprudential controls, you can get around them. But that's exactly what they said about self-insurance. In 2003, the idea was that it would be simply impossible for emerging market countries to self-insure against sudden stops. But we know that they did that against one of the biggest sudden stops they could ever have experienced during the global financial crisis. And therefore, self-insurance did work, but the point is that it went far beyond simply accumulating reserves. It also dealt with the public finance problem and the contingent liabilities from the private sector. The second area where countries made remarkable progress, and I particularly highlight the successful experiences of Brazil and Turkey, is that they were able to overcome this label of being debt intolerant. And they did it quite quickly, and they did it essentially by raising primary surpluses. And it took them a long time, but it was the determination to do that that eventually succeeded. Now, although CESEE may be maybe a different case or maybe an exception, partly because financial integration in CESEE is just a small part of the picture. The integration has gone far beyond finance. It includes trade, it includes the institutional pull of the EU, and that's a factor which my World Bank colleagues have identified as a very important factor in driving the successful experience of CESEE countries with capital flows and the positive growth benefits. So essentially, the way I look at it as someone who looks at it from a distance is that the real challenge is how do you get reliable, high-frequency information on things like incipient asset bubbles and external in real estate, or how do you monitor the vulnerabilities of bank balance sheets and take decisive steps? And of course, there are two questions that remain open, which is how much policy space do you have left to combat a new round of extreme volatility? And I think this is very important against the background of the discussion we had this morning. And also, how do you coordinate and share information across emerging markets more generally? Yeah, we'll skip the references, and since Marek Belka is one here now, Marek, I started by expressing my gratitude to you for inviting me to participate in this very important conference. So thank you very much.
Thank you, Brian. You kept perfectly to the schedule, 12 minutes exactly. I should just tell you should not keep on excusing yourself for not being central banker and maybe being a naive, because I know many people who would claim just the opposite, that being one you might be naive, particularly during the crisis. But now we're switching to the country experiences. First, ERDEM BAŠČI, who was deputy governor like myself for 8 years, and since the April of this year has got into the driving seat of the Central Bank of Turkey. Congratulations first, ERDEM. And now they'll tell us how do you see your job with still, I don't know, capital inflows probably seen as a potential a problem for monetary policy in Turkey. Thanks.
Thank you very much. Thank you, Boris. And also, I would like to start by thanking Governor Belka for personally inviting me to this maybe a year ago or something, when I was a deputy governor at that time. So thank you for the invitation, and I'm very happy to be here. Now, about this topic, since I have just 12 minutes, I will just start with this Europe, I should say, approach to capital flows, because Europe, as you know, is against using any capital account restrictions, any capital flow measures in face of such a problem, capital inflows and outflows problem. So you have to devise new strategies, new instruments, which are not capital flow measures, if you want to cope with this problem. Another approach is, if there is no solution, there is no problem. So let the capital flow in, let the capital flow out, and follow the orthodox approach, floating exchange rate regimes, and fixed interest rates, and try to do the best on inflation targeting. So that kind of an approach is also possible. But we thought we should do more, a bit more, after quantitative easing too. As Boris has mentioned in the beginning, last year all countries were complaining about short-term capital inflows thanks to global monetary expansion and QE2. Now nobody seems to be complaining much about that. There seems to be some outflows, but not much. I should say at least some weakening. I should say some weakening of inflows is there. So basically, the recipe is not so complicated. If there are strong inflows, if you have multiple instruments, what you could do is, number one, you could buy foreign currency. Number two, you could hike reserve requirements to contain excessive credit growth. Number three, you could cut the policy rates. So these three are quite straightforward. If there are weak inflows or if there are outflows, you could sell a little bit foreign currency carefully. You could cut reserve requirements, obviously, to support the banking system. And at the same time, if needed, you could hike the interest rates. So you just do the opposite of what you did during inflows. So having said that, it seems that the central banker's job is relatively easier than the job of finance ministries nowadays. So you can just tighten and ease as appropriate. So there is not much problem there. I will just share with you, since we have limited time, some Turkey-specific policy instruments and policy measures here. One of them is also not very original. It is unremunerated reserve requirements. We simply stopped paying interest on reserve requirements before we started using reserve requirements as an active policy instrument in order to have a more effective policy instrument, because there would also be a cost channel, so that you can distinguish across maturities of inflows, you can penalize short-term inflows and incentivize long-term inflows by using different reserve requirements across different maturities. So this is really not something completely new, because I know that many countries in the Balkans also use such different reserve requirements for different maturities. But it takes some courage, I should say. It takes some courage to stop paying interest on your reserve requirements. The banking system would not be happy with it, to say the least. So that's what we did. To start with, we just stopped paying interest and then start hiking reserve requirements during inflows. Now, right now, what we are doing is we have started cutting the reserve requirements in order to help the banking system in face of weakening, I should say, capital inflows. So that's relatively clear. Now, the one which is really specific, I should say, to Turkey is the active use of the interest rate corridor. The interest rate corridor against capital inflows and against capital outflows. So for that, I would like to show you perhaps a few pages from this presentation. You can, I think, find this presentation, the overall flow has some logic, so I better not do that. But I will just show you this interest rate corridor together with the reserve requirements in Turkey. So here you see, after cutting the policy rates quite significantly post-Lehman, what we did post-quantitative easing 2 is we have cut, which one should I use? Okay, let me try this. Okay, no problem. We have cut the borrowing rate very significantly, all the way down to 1.5%, and thereby widened the interest rate corridor to the south. So what does this do? What this does is, provided that you are funding the market, provided that your policy rate is the 1-week repo funding or lending rate, then it gives you some flexibility, some downward flexibility in the secondary market interest rates. So you can have secondary market interest rates deviate from your policy rates to the south, occasionally, not always, from time to time. You can do it by mistake. You can do it by deliberate action, or there could be other ways of doing it. Now, what this does is it discourages extremely short-term carry trade positions, because the expected return in overnight position becomes volatile. So therefore, the expected return divided by the standard deviation of the exchange rate hovers around all over the place. So it's very extremely risky to take an overnight position in the currency. So it worked, basically. I will show you what it did on the currency. But now, right now, we have hiked recently the interest rate corridor. Actually, this has taken place yesterday. So in our MPC meeting yesterday, we decided that we are going to hike the lending rate of the central bank by 350 basis points. So we have hiked the corridor to the north now, this time. So what this does is it introduces some tightening bias, but you don't really increase the funding costs of the banks to a large extent. You just introduce some element of uncertainty there, some element of volatility there, so that they would also reflect this uncertainty and volatility on their pricing of credit, because credit still grows very fast in Turkey. Despite all the measures that we have taken, the real growth rate of credit in Turkey significantly exceeds the real growth rate of the economy. So we better slow it down further, although there has been some progress. So therefore, there is no harm in tightening via policy rates, but without harming the overall cost structure of the financial system. And this would also be good for currency because currency has already depreciated quite a lot. And we would not be happy with further sharp depreciations in this global uncertain environment. So this we use as a protective device on currency. So as Brian has mentioned, we are trying to travel within the triangle, within the trilemma triangle, rather than at the corners, by introducing some flexibility on interest rates in order to reduce some flexibility on the exchange rate. So this is the bottom line. On the right-hand side, you see the reserve requirements. And we have the maximum reserve requirements at 16%. This is for less than 1 month, and minimum at 5%. This is for longer than 1 year maturity for deposits. For Eurobonds issued by the banks or syndication loans, securitization loans, we have 1 year, 1 to 3 years, and longer than 3 years, 3 categories of different reserve requirements. And we have hiked quite significantly, especially in the first quarter of 2011, after the QE2 has started showing effect on extremely rapid expansion on credit. So let me show you some of the results, maybe. I mean, this recovery picture is nice because we have a very clean V-shaped recovery, but if you look at a long-term perspective, we are still below the trend line. We have just approached the trend line. But given the global environment, this is too fast, I should say. So if the world is stagnant, then can you grow rapidly? The answer is yes, if you can manage the external accounts. So obviously, Turkey gives a huge current account deficit thanks to a recovery of domestic demand. So there are limits. There are limits on growth in this environment. So we better slow down a bit, and we are doing that. And this is about inflation. So all the financial stability aspects have been addressed, but at the same time, we have been very careful on price stability. And overall, there is a convergence to emerging markets average of inflation. And we have to be very careful about this disinflation process. Right now, there are risks in the coming months, so we have immediately turned to a tightening mode by hiking the interest rate corridor to avoid future risks on inflation. But our topic right now is the credit growth and currency. So for that, I will just skip those and show you the credit and currency developments, especially with instruments that also differentiate across foreign currency versus domestic currency loans. We were able to bring down the growth rates of US dollar borrowing, domestic borrowing, down. Since 2009, borrowing by Turkish households, Turkish consumers in foreign currencies is forbidden. So that helps, although they can hold deposits in foreign currency. That also helps. So the households right now are in net long position in FX, while the firms, the companies, are in net short position in foreign currency. But this is much better than our peers, especially in Eastern Europe. So it really helps to dampen the fluctuations in the currency as well. So the credit growth, overall credit growth has also slowed down and came closer to the seasonal averages and sometimes below the seasonal averages. And I should show you the consumer loans especially. The consumer loan growth, the red line has been extremely fast, 45% year-on-year consumer loan growth. In first half of the year, 45%. This is faster than China, and shouldn't be that fast. So after some measures, some macroprudential measures by the bank regulator and by the central bank, we were able to take the growth rate down to 20%. But 20% is still high. So part of this is fed by deposit growth, which is in the order of 20% for lira deposits. So in that sense, it's fine. But still, 20% consumer loan growth is not so bright, I should say.
Can you wrap up?
Yeah, I will just finish with currency. Now, about currency, the lira was moving in tandem with emerging markets average, but after our measures it started diverging, and there has been some depreciation since November 2010. And right now, when the other emerging market currencies depreciated very sharply, especially starting from August recently, the lira's depreciation was not as sharp, I should say. So that early depreciation, early on depreciation, helped at a time of sudden stop kind of behavior. So this is the picture that I would like to show you. And then the real effective exchange rate is right now at all-time lows. So fundamentally, the lira is weak right now, so that there is not room for further weakening from fundamental point of view as well, but monetary policy stance has also changed against depreciation. So we have communicated this on yesterday, and we are looking forward to the results. And this graph also summarizes that the extent of depreciation in lira versus other countries before August and after August. So I think one of the better performance is Israel after August. The depreciation has been very limited. So maybe I can just leave the floor to KARNIT for that. Thank you very much.
To hear the experience of Israel. On the right note. Thanks, ERDEM. It's pretty much the story of the Central and East Europe also that you told us. Lots of worry about the rapid credit growth, capital inflows, possible loss of competitiveness, and all kinds of measures that we introduced. We even introduced the capital inflow tax in Croatia, which worked very well, which contrasts quite a lot with what we heard, I think, in the morning, where you see, I was comparing, for example, looking at the credit growth in peripheral countries without Italy, so the Greece, Portugal, Ireland, and Spain. So in 10 years from 2000 to 2010, they increased their credit to GDP ratio from 85% to 165% of GDP. And it seems there were no papers, no worry about what's going on there, while at the same time you had a number of papers, lots of monetary policy measures done in the Central and East Europe to curb the credit growth, which was actually lower than it was in the peripheral countries, and which only brought the credit to GDP to some 50% of the GDP, which is also probably one of the root causes of the problems that we're dealing now within the Eurozone. But let's hear the experience of Israel from KARNIT FLUG, who also very recently, even more recently, has been nominated deputy governor of the Central Bank of Israel. So again, congratulations to you, KARNIT. You've been with the Central Bank also for more than 20 years after some experience in the IMF. And please share your experience with us.
Okay, thank you very much. And I also want to thank the National Bank of Poland and the governor for inviting me for this very, very interesting and thought-provoking conference. What I'll do is try to share with you the Israeli experience with dealing with the very significant challenge of very large capital inflows over the last 3 years. I'll start, if I know how to operate this, okay, with some basic facts. We have experienced since the early 2008 very substantial appreciation of our currency, and it was intensified by capital flows, large capital inflows, particularly short-term. At the background, in early 2008, we were already sort of seeing or expecting or fearing a global recession, which was not quite fully blown, but the potential of severe recession was already there, and it was clear that it will have a significant effect on a very export-dependent economy like Israel. So in the beginning of 2008, before the full recession, we actually started accumulating reserves, starting buying foreign exchange in large quantities. I have to say in parentheses that it was motivated also by our assessment that reserves were too low. So we had a study which suggested that we need to increase reserves, and the high and rapid appreciation was sort of a good time to start increasing reserves. We've done some studies which suggest that actually the intervention over the last 2 years starting in March of 2008 had quite a significant effect on mitigating the appreciation. And obviously a more depreciated shekel or currency relative to what it would have been was quite important in mitigating the effects of the global crisis on the Israeli economy. So let me go into a little bit more details now. What you see here is on the top part of the slide is the inflows by non-resident investments into Israel. And on the bottom, you see investments by Israelis abroad. And actually, in the left-hand side, you see the annual rise in both inflows and outflows, which were the result of capital account liberalization that took place in Israel. But if you focus on the period of starting in 2007 and onwards, these are quarterly data, you see that the inflows actually continued, but the outflows were actually going down, and at some point, some of these flows actually became negative when Israelis started bringing money back to Israel, when there was a perception that Israel will probably not be as hard hit by the problems that were already starting to emerge in the developed countries. So both flows actually at the time worked towards an appreciation of the currency. So what we see here is that on the top part of the slide, you see the exchange rate vis-a-vis the US dollar, and you see that in 2007, we had after a mild appreciation of the currency, there started a fairly sharp appreciation, and that was also translated into a sharp appreciation of the trade-weighted real effective exchange rate. That appreciation was partly as a result of the capital inflows, which I already mentioned, but also they were originated also from a significant current account surplus. So the two actually worked towards appreciating the currency, and the mark there that you can see is the beginning of the purchases of foreign exchange that we started in March of 2008. Our assessment of where the level of the exchange rate is relative to the fundamental equilibrium exchange rate was suggested that there was a significant deviation at the time where the actual currency was much more appreciated than some concepts of fundamental equilibrium exchange rate. So that was also part of the sort of picture that was behind our decision to intervene. How did inflation look at the time? If we look at the period prior to the crisis is marked is the gray area where the economy actually entered into a recession. But prior to that, you can see that the consumer price index was running at rates which are above 3%, which is the upper limit of our inflation target range. Our inflation target range is between 1% and 3% at all times. So inflation was higher before the recession, and also inflationary expectations looking 1 year ahead were close to the upper part of our target range. During the recession, although inflation continued to be above target, you can see a sharp drop in the inflationary expectations, so that during the period of the global recession, actually they were below the lower bound of the target range, and even became negative for some time, and then started, as the economy started recovering, the inflation expectations started moving back again towards the upper part of our target range. how did the real economy look at the time? If we look at the period prior to the global recession, you can see the blue bars are representing growth, and the red line represents the growth of exports, and that's on the right-hand side scale. So you can see that the economy was growing at quite a rapid pace before the global recession started. With actually the exports being the engine of growth and exports growing very fast, but then they were also the engine in a way of going down. And you can see that when the economy started feeling the effects of the decline in the demand, in the global demand as a result of the slowdown in the global economy, exports were the first to go down, and they were actually pulling the economy down during the recession period. But then also in the pink period, the period of the recovery, it was exports that led the recovery from the recession. So that was the background in terms of inflation and in terms of the real economy that we were facing when deciding and when thinking about monetary policy. So how did monetary policy respond to all of that? Let me start, before I go to our involvement in the foreign exchange market, let me just mention that prior to the beginning of the recession due to the global recession, our interest rate was at 4.25. And we actually, when the recession started, just after the collapse of Lehman Brothers, we reduced very sharply the interest rates to half a percentage point, where it stayed until September of 2009, and then we started gradually increasing the interest rate. What about the foreign exchange market? I mentioned already that we started purchasing foreign exchange at a daily rate of $25 million a day in 2008, with initially the motivation of increasing reserves, but then also at the background we had the sharp appreciation of the exchange rate. In July of 2008, we increased the purchases amount to 100 million per day, and we continued that at that pace until August of 2009. At that time, we announced that we will no longer continue with the fixed purchases of foreign exchange, but we also reserved the possibility of intervening in the foreign exchange market if we would view the fluctuations in the exchange rate as such that do not match the fundamental underlying economic forces. And in fact, we continued periodic intervention or purchases of foreign exchange until recently, until about 3 months ago. In January of 2011, we announced 2 other measures in the foreign exchange market. One was the reporting requirement, which was imposed on certain activities in the foreign exchange market, particularly on short-term inflows and on involvement in derivatives in foreign exchange. And the motivation was, yet again, to make it somewhat less attractive for the massive short-term flows to go in. And we also imposed a reserve requirement on the foreign exchange derivative transactions by non-residents. So I want to now focus on how all of these parts of the monetary policy and exchange rate policy fit together.
Can you end up with that then?
Yeah, that's the one before last slide. Okay. So I think the first period where foreign exchange purchases were motivated by the need to increase reserves, and at the time the economy was still growing quite strongly, and inflation was quite high, so there was a combination of purchasing foreign exchange and raising interest rate. The period of the recession was such where both inflation pressures were very subdued. Actually, inflation was running, or expectations were running below the inflationary, below our target. And the economy was also in a recession, and particularly the export sector. So both the decline in interest and the purchases of foreign exchange worked in the same direction so as to inflate the economy and to support the competitiveness and growth. The third period, the pink period in this slide, is actually the most challenging one. That's when, on the one hand, we started seeing inflationary pressures rising, so there was a need to actually tighten monetary policy, and that was done by raising interest rate. On the other hand, the competitiveness was still quite low. There was the large inflows of capital put quite significant pressure on the exchange rate for the appreciation. So on the other hand, we continued purchasing foreign exchange. Now, it's true that the increase in interest rate at the time actually encouraged the inflows, the short-term inflows, and so there was a tension between the two policies, but the idea here was that we would not want the export sector and competitiveness to bear most of the brunt or the burden of the tightening of the monetary policy, and therefore we actually took the two types of measures together, but we then introduced the reporting requirement and the reserve requirement so as to reduce the attractiveness.
And we have to leave some space for questions.
Okay. So just to sum up with the last one, I think large capital inflows, of course, challenge monetary policy, and the challenge is intensified during periods when competitiveness and growth considerations and, on the other hand, inflation considerations called for different types of policies. We think that the combination of the interest rate policy and the foreign exchange intervention actually worked quite well for the Israeli economy.
Okay, thanks a lot. Since we do not have much time, I'll first go to the audience now for the questions, and maybe pick 2 or maximum 3 for the panel. So, who would like to have a question? I have some of mine, but first, let's give a priority to the audience. Let me start then. Well, the one thing that worries me always when I look at the capital inflows in the emerging market countries, but not only emerging market countries, as we've seen in the European periphery, it was also a question not just, you had a cheap credit, you had a cheap money flowing in. So what's wrong with the cheap money flowing in? It's better than expensive money flowing in, you would say. But the problem is that if you have too much of it, then you have a problem usually of intermediation. It doesn't get intermediated properly, so you end up with lots of debt in the end, which you cannot service. So from the perspective of the composition of the inflows in the emerging market countries these days, and the macroeconomic management of the intermediation and microeconomic intermediation management of these capital inflows, where do you see risks? Do you still see the risks? Do you think we have gone a long way in learning the lessons also on how to intermediate the capital inflows in order that the debt component of them can be repaid further down the road? Or you think there are still lots of things to do there? And maybe the second question, again, when we go back to the morning discussion is, well, if things do go wrong in the Eurozone, which we all hope they will not, where do you see the risks for the emerging markets? I've seen the latest poll of the Morgan Stanley of 200 largest investors, and it's approximately half-half in terms of how do they see the effect on the emerging market countries. Some say they will be relatively mildly affected. The other half says they will be they will be severely affected. So what's your view on that? And if you can take each of you like maybe 2 minutes each to address maybe one or the other question. We can start maybe from ERDEM and then go all the way down here.
I mean, the problem with this monetary expansion at the Federal Reserve or now at the ECB is that these are extremely short-term assets of the banks at extremely low interest rates. So they are seeking yields, as we all know. So the implication of this is not only too much inflows, but also too much debt rather than equity. If it is debt, it is short-term rather than long-term. And in terms of currency composition, it is foreign currency rather than domestic currency. So that's the problem. Otherwise, we would be quite liberal regarding capital flows. But these three aspects are not that healthy. So we have to counteract by policy all three aspects. About Eurozone, if there is no solution on Monday, we altogether are in deep trouble. So that's clear.
Okay. I think you're referring to short-term flows, and I think that actually a recent study by Joshua Eisenman and some other colleagues suggested that their effect after the crisis was detrimental to growth rather than helping growth. It's foreign direct investment that is helpful to growth. So I think there are good reasons to actually discourage these flows, and I don't see their benefit, the short-term type.
Including capital inflow taxes.
Yeah, including intervention, capital flow taxes, and so on and so forth. I think another way of dealing with the potential reversal is to really keep a decent amount of reserves so that you will be able actually to slow down in case there is a sharp reversal of these flows.
Mm-hmm. Which, as you said, the emerging markets did. They increased the foreign exchange reserves, but also they reduced overall reliance on the foreign savings by increasing their national savings rates. Over the last 10 years, basically all emerging market countries have increased their national savings rates, which helps. Brian.
Thank you, Boris. I think you were quite right to point out this problem with the volatility of financial intermediation, and essentially, which is related to this question of short-term capital inflows. And here, I think that central banks have to move very aggressively to tax external borrowing surges in particular. And Hyun Song-shin had mentioned this in the context of Korea, where he noted that if banks, if their asset base is increasing much more rapidly than deposits, then it's valid to think of taxing these external borrowing surges, because in a way they are very similar to deposit insurance, if you think of it, because the FDIC charges a risk premium for insuring deposits, which is essentially, if you like, an ex-ante tax on borrowings by banks from households when they place deposits with them. And the point of this, of moving aggressively on this, is that the externalities associated with these costs are eventually borne by the taxpayer. So there is a case for taxing the external borrowing surges. And the other is on house prices, to monitor these very carefully, because banks are essentially transforming short maturity borrowings into long maturity assets, including possibly lending for mortgages. And that's, once again, an area where house price collapses have very costly effects, very often for the public finances because of the need for a bailout.
Good. So the capital taxes are okay. We should care about the asset prices, actually, not discourage them. So the world has changed, obviously, a lot. And I thank you for your contribution to the panel. Let's give applause. Mm-hmm. And we have to move to another panel on, this time on the fiscal policy, which is, as Jacob would say, the key instrument that is kind of not really playing well lately. Okay, so now again for something completely different, as you said, fiscal policy, although not completely unrelated. We have an excellent panel here, which will talk this time more about the Central and East Europe and the fiscal policy in the Central and East Europe. The Central and East Europe, at the beginning of the crisis, if I can say, did not appear to be really a fiscal sinner. Actually, Central and East Europe looked there in 2007, 2008, at the beginning of the crisis, as one of the regions with the lowest debt to GDP ratios in the world, particularly Baltic countries, but also Southeast Europe and Central and East Europe. And during the crisis, and even after the crisis, it seemed to be doing relatively well in terms of the fiscal adjustment. Some countries maybe had even the fiscal space because of that to countercyclically react. People mentioned Poland, for example. We'll probably hear a little bit about as well. But I will this time go again by probably a presentation that will be more general by Carlo Cottarelli, who is the director of the Fiscal Affairs Department in the IMF. And then we'll go to probably maybe a more country-specific presentation by Dario Rosati, and finally by Vito Tanzi. So, Carlo, please.
Thank you very much, Boris. I will just show you some numbers, some data about the fiscal situation in the region. It's clear that the impact. How does this? Let me see. Okay, it's clear that the crisis had a major impact on output growth in the region. With growth declined, output declined a bit more than in the euro area. Although, of course, there are differences within the region, ranging from Latvia with a decline in GDP of 18%, while Poland, for example, managed to avoid a recession. The shock was also very large for the fiscal accounts, with the average fiscal deficit rising to 6% of GDP in 2009, 4.5 percentage points of GDP larger than before the crisis in 2007. Now you see there is an improvement in the last 2 years, but even this year we project a deficit to GDP ratio of about 4 percentage points of GDP. How about debt? The level of debt before the crisis, as you know, was well below the euro area level. The increase in debt during the crisis was also smaller than in the euro area level, but was still very significant, almost 20 percentage points. This increase in deficits and in debt was entirely driven by the behavior of revenues. This is the growth rate of spending, which during the crisis, which was more or less in line with the growth rate of spending in the pre-crisis period. But what was dramatically different was the behavior of revenues. Now, revenues collapsed because of the decline in GDP, but the decline in revenues exceeded the decline of GDP for at least a couple of reasons. First of all, before the crisis, revenues had been sort of inflated by temporary factors, capital inflows leading to demand boom and asset price increases. Second reason was the fact that, and this happens in the region like in any other region, when there is a crisis, a decline in a recession, particularly a very large decline in output, then you have a weakening of tax compliance. And so one question looking forward is how long it will take before tax compliance goes back to the pre-crisis level. In this series of slides, you have a more granular look at the fiscal data. Here you have data country by country. This is 2007 for the debt to GDP ratio on the horizontal axis and the deficit to GDP ratio on the vertical axis. And you can see clearly the shock. This is 2008. 2009 is the worst year in terms of deficit. Nothing much happens in 2010. 2011 is when you start seeing some improvements in the deficit, but you continue to see the countries moving to the right in terms of that. And the same more or less happens in 2000, is projected to happen in 2012. Compared to other emerging areas of the world, the fiscal accounts of the euro of this region are not particularly good, particularly in terms of deviation with respect to the 2007 situation. Europe, emerging Europe, is still not in a very good situation compared to other emerging regions. This gives you a sort of summary of where we are now. On the horizontal axis, you find again the gross debt to GDP ratio for 2007. On the vertical axis, you find the deficit to GDP ratio for 2011. The balloons here are proportional to the spread that these countries pay, and the red balloons are the countries in this region, the blue balloons are the one in the euro area. It's clear, first of all, that compared to many countries of the euro area, the fiscal accounts of this region are not too bad. They are quite relatively better. It's also clear that spreads are equally large or even large, which shows two things in my view. First of all, some contagion effects, some spillover effects coming from Europe, which needs to be kept in mind in terms of policy formulation, future fiscal policy formulation. And second, unfortunately, it shows that emerging economies are regarded by markets to be less tolerant than advanced economies when it comes to public debt. Given this situation, how much adjustment is necessary for the future? Now, here we have updated a simulation that we have done, that we do routinely in our fiscal monitor, this new publication of the IMF. We do it for emerging economies and advanced countries. The idea is the following. Let's calculate, let's assume that the goal is to lower the debt to GDP ratio to 40% for emerging economies and 60% for advanced economies. This is the simulation that Jean mentioned this morning, by 2030. So in 2 decades, we go back to below 40% and below 60%. How much should be the, and assume that the primary balance improves linearly every year in the same amount for the first 10 years, and then the primary surplus is kept constant for another 10 years. How much adjustment in the primary balance, cyclically adjusted primary balance, is needed? And this chart answers this question for the countries of the region, as well for the average of the euro countries. And you can see that the average adjustment is not trivial. It's not as large as in the euro area, 5 percentage points of GDP. This number for advanced countries, including Japan and the US, is as large as 8 percentage points of GDP. But for the euro area, it's still large, 5%. For the countries in the region, is about 3.5% of GDP. So it is a fairly large adjustment. This is how much has already been done. As you can see, the countries like Latvia or Romania have already completed the adjustment that is needed to lower the debt to GDP ratio below 40%, given this time target. Others, however, still have quite a long way to go. Let me clarify one thing. This is illustrative. Obviously, this calculation is based on strong assumptions, in particular the assumption that the adjustment takes place in the first 10 years gradually, same amount every year. If a country has a more front-loaded adjustment, then it can achieve the 40% target faster, and probably also with a lower adjustment, because the adjustment comes early, so it accumulates in terms of reducing the debt to GDP ratio. And this, I believe, is the case for Poland. This adjustment will have to take place during a period, 10 years, 20 years, 5 years, in which spending for pensions and healthcare is projected to increase. We project healthcare spending and pension spending for the countries in the region to increase by 2.25% of GDP over the next 20 years. This means that compared to the trend at current policy, the adjustment will not be 3.5%, 3.75% of GDP, but almost 6 percentage points of GDP. So it's clearly a major effort that is needed over time to lower the debt to GDP ratio with these targets in mind. How fast it should be done? What are the key principles to drive this adjustment? As I said, this is an illustrative scenario. First point I want to make, all countries should have a clear plan. Should have a plan not only in terms of targets, but also in terms of tools to achieve those targets. Second point, within this plan, the speed of adjustment depends very much on various country-specific features. The level of spreads, market access, economic growth prospects, the level of debt, of course. My sense, however, is that for the countries of this region, it is important to start adjusting or to continue adjusting relatively sooner than later, because prospects in Europe are very uncertain, because fiscal space is limited. Basically, when your neighbors are having a fiscal crisis, then you better keep your fiscal accounts in order to avoid spillovers. Last 2 points I want to make. This adjustment is going to take time, and therefore it's important that it is supported by good fiscal institutions. This picture gives you our assessment of the state of fiscal institutions in the average of the region based on a number of parameters like independence of fiscal agency, fiscal reporting, macro fiscal forecasting, that we regard as relevant in terms of institutions. This is the picture for the region. This is the picture for emerging G20 economies. So it's comparable, it's not too different, but it is still weaker than the fiscal institutions in more advanced countries. So further progress is needed. The basic idea is that in the region has relatively good public finance laws, but implementation is still lacking. And the last point I want to make is very quickly is about growth. Ultimately, to be sustainable, fiscal adjustment would have to be accompanied by growth, continued growth. Therefore, it is important to continue the process of structural reform in labor markets, in products markets, energy, transportation, social assistance, education, which are all important to sustain, to maintain high potential growth over the medium term. And with this, I would like just to thank you for your attention.
Thank you, Carlo. Very interesting. We'll have to talk a little bit about some figures for Croatia, but we'll do that after the panel. Darius Rosati, whom most of you know very well, is former Minister of Foreign Affairs of Poland and currently a professor of international economics at the Warsaw School of Economics. Darius, I guess you'll share a little bit more of Polish experience with us, please.
Thank you, Chairman. Good afternoon, everybody. I'm afraid I'm a bit in a difficult position because a lot of points which I wanted to raise have been just raised by the previous speaker, and if anything, I'm going to support most of his observations. So with the risk of making some repetitions and some overlaps, I will try to focus on 3 points. The first, I'd like to give you a short overview of the current fiscal situation, not in the whole CESEE region, but rather in EU 10 new member states of the Union. Then, with the use of a simple analytical framework, actually a textbook setup, I would like to show you why high debt levels, high public debt levels are associated with lower GDP growth rates and with higher interest rates. And finally, I'd like to developed that simple framework, adding one important dimension, which I call a sovereign risk channel. And then I will conclude. Let me perhaps skip this fiscal situation in the European Union. This overview is definitely well known to everybody, and I will go straight to the evolution of the situation in fiscal deficits of the two groups of countries, Euro area 16 and EU 10. As you can see, actually, when the deficits are concerned, there is a lot of symmetry in development in the two groups of countries between 2004 and 2010. The two lines are almost identical. And even the deterioration since 2007 has been very, very similar, actually. The increase of deficit for the two groups is the same. The deficit went up to 6% of GDP. So on this front, there is a lot of similarity. When we look at the debt evolution, then there is, again, at the first glance at least, we see a similar trajectory of debt for the two groups of countries. But one important difference is that the level of the initial debt level in the Euro area countries has been much higher, above 60%, and now the level reached at the end of 2010 is 80%, whereas in the group of the new member states, these debt levels are much lower. They are lower by some 25–30% of GDP. Now, one important difference which can be observed when we compare this crisis episode with previous crises is that at every crisis episode in the past, be it caused by the oil crisis in the 70s or 80s, or by financial shocks in the 80s, the magnitude of deterioration of the fiscal position of the countries has been similar. That is, each time we had an increase of public debt by 15 to 20% of GDP. So there is no difference in the deterioration, but there is an important difference in one aspect, and namely the starting point of public debt this time has been much higher than in previous debt episodes, previous crisis episodes. So this time, especially in the euro area, the debt level, the initial debt level was much higher, was, as I said, more than 60%. And the same deterioration by 20% of GDP elevated the whole debt level up to 80%, which is very high by historical standards. Now I move on to this standard debt dynamics framework, and this is, as I said, a textbook stuff, so I'm not going to elaborate on this. Let me just recall the first equation. The first equation is on the left-hand side, we see the increase of the debt ratio, and on the right-hand side, we see the proportion of the budgetary deficit to GDP, plus the so-called snowball effect, depending which simply represents the combined effect of the changes in the growth rate and changes in the level of interest rate. And finally, the last term is the stock flow adjustment. Now, if we want to stabilize the debt to GDP ratio, of course, the left-hand side has to be 0, and then the whole stability condition can be derived as the second equation, that is the annual primary deficit in absolute terms must be equal to the debt in the previous period times the differential between the GDP growth rate and interest rate. Now, it can be shown that for high debt levels, actually, this equation becomes nonlinear. And this is because for high debt levels, both the GDP growth rates tend to fall and the interest rates tend to rise. So that the differential between the two not only becomes negative after some level of debt is exceeded, but also becomes larger in absolute terms. And this, of course, is clear that this requires the primary balance to be positive and growing as proportion of GDP if you want to stabilize, the debt to GDP ratio. Now, why it is so that these high levels of debt are associated with smaller and smaller GDP growth rates and higher interest rates? Well, first of all, we have this effect of the high debt level on the cost of servicing the debt. That is, the total cost of debt service in relation to GDP increases together with the debt level. And the higher is the debt service in absolute amount, the higher have to be taxes, and of course less resources is available for all sorts of development objectives for investment in the first place. And that, of course, translates into slower growth, that is, slower growth rate. The second factor is that for higher debt levels, also risk premiums in interest rates increase simply because there is a growing risk of default. And that, again, makes the interest rates increasing together with the debt level. So finally, we have these debt levels, high debt levels, that translated to lower GDP growth rates because of higher taxes, anticipated taxes or current taxes, and then lower investment, plus higher interest rates. And there is a wide body of empirical research on that, which demonstrates that when the debt level exceeds certain threshold level, then it significantly affects the GDP growth in a negative way, of course. And let me refer to two studies on this. One is by Reinhardt and Rogov of 2010. They found that this threshold above which the debt level becomes really detrimental to growth is about 90% of debt. And the other is by Stefan Cecchetti and other authors. I don't know whether Stefan is here in this room. So I want to thanks for this result. And this is 2011. And again, this is the result is that the threshold level is somewhere between 80% and 100% of GDP. Now, these are debt levels much higher than those recommended by Jean Pisani-Ferry and also by Mr. Cottarelli here. But of course, they represent a certain average across a panel of countries. Now, there is one more dimension which comes to the fore when we analyze the situation in the context of the present crisis. And this is the sovereign risk channel. Because the standard debt dynamics which I've shown in the previous panel does not include this two important relationships, actually, which can be observed. The first one is that there is a negative spillover from increased sovereign default risk, which is reflected in rising bond spreads and rising CDS, to the rest of the private sector, to the rest of the economy, especially to the private sector, and this spillover affects negatively the borrowing cost for the private sector. This is simply because the financial sector assumes that once there is a higher borrowing by the public sector, then of course we will have also a higher possibility of taxing the private sector in future. So this is one mechanism which drives the cost for borrowing for the private sector higher whenever we have high public debt levels. And this, of course, again translates into slower growth. And the second relationship, the second mechanism, is the spillover from into the banking sector. As we all know, no banking institution in a given country can have a higher rating than its sovereign. So, of course, a downgrade of sovereigns entails downgrades of financial institutions, and this, again, causes the banks to pay more for capital and, of course, forces them to reduce the credit emission, which results in a credit crunch and, again, a slower growth rate. So under these conditions, we have this strong negative impact of high debt levels on aggregate demand, which falls with the increase of sovereign risk. And then above certain level, it turns out above certain level, the public debt cannot simply be stabilized. Because if the differential, if the differential falls, because the rate of growth is falling and interest rates are increasing, then the whole differential becomes negative and large in absolute terms. Then, of course, this requires very high primary surpluses to be produced every year in order to stabilize the debt. And now we know that there is an upper limit to primary surpluses determined by political constraints. And this I owed again to Blanchard, who invented this maximum politically feasible primary surplus in one of his first papers on this topic, which simply says that above certain level of primary surplus, it pays off for the debtor country simply to default rather than to honor its obligations. So finally, we have such a situation that the risk of default is looming large in countries that are most heavily indebted. And let me note that some of the countries in the euro area are close to this threshold or well above. Actually, this is the case of Greece, of course, but probably other countries are also already above the threshold, which is deemed to affect negatively growth rate and which requires very substantial surplus, primary surplus to stabilize the debt. So on balance, we have the need to consolidate, but through large primary surpluses, and this large primary surplus can perhaps in some cases may not be feasible politically. On the other hand, to reduce the differential and increase GDP growth rates in order to reduce the value of the differential in the equation of the debt dynamics may be economically not feasible, at least in the short run. What does it mean for the Central European countries? They have generally much lower debt levels, right, than the euro area countries, except for perhaps Hungary is an outlier in this respect with 80%. But the next country, Poland, around 55%. All other countries have much lower debt levels. But this is not really a consolation, because it turns out that risk premiums for these countries are much higher. So even though the initial debt levels are lower, then the differential, again, the differential between the GDP growth rates and interest rates may actually be smaller than in more advanced countries or in the euro member area countries. And this means that there is no place for complacency also in Central European countries that have much lower debt levels. In order to illustrate this, this higher risk premium in the Central European countries, I just give a comparison of bond yields, 10-year bond yields for Poland and Italy, which are broadly the same at 5.8, even though the Italian public debt is 120% of GDP and the Polish public debt is 55%. And similar relationship we find for Austria and the Czech Republic. Again, the bond yields are around 3.2 for the two countries, but the debt level, again, in the Czech Republic is less than 50% of the debt level in Austria. So we have here clearly the factor of the higher risk premium, which puts an obligation for the Central European countries to consolidate their fiscal positions probably equally fast and in an equally determined way as the euro area. And this is actually my conclusion, that even though the public debt levels are much lower than in the euro area, they're much lower in the new member states, nevertheless, there is a strong need for public finance consolidation also in those countries. Of course, if we were able to restore confidence in financial markets and reduce these risk premia in interest rates, then probably some of the Central European countries could have gained a little bit more room for fiscal maneuver. But for the time being, it's not in the cards. Thank you.
Okay, thank you, Darius. Finally, last but not least, we have Vito Tanzi, who needs a little introduction, I think. He's been, among other of his functions, for the most of his career, actually predecessor of Carlo Cottarelli as the director of the Fiscal Affairs Department in the IMF. He wrote extensively, particularly on the fiscal policy. There's even a effect that we know, Tanzi effect in the economics. I'm looking very much forward to what Vito has to say about the current fiscal problems.
Thank you very much. I feel very much in the position of Elizabeth Taylor's eighth husband on the first night, you know, that he knew what he was supposed to do, but how do you make it interesting, you know? You know what, almost everything that I was going to say has already been said, so I'll try to complement it in some way, trying to emphasize some of the points. The first point that I want to make is that clearly there has been a major fiscal deterioration in the countries that we are talking about. You know, they had a very, very good situation before the crisis, but during the crisis, both the fiscal deficit went up, public debt went up, and to me, what is worrisome also, public spending went up. You know, and I think spending, in fact, went up by more than perhaps. My friend Cottarelli said, you know, that my reading of the data is that there was not all that much change in the revenue. There was much more change in expenditure for most of the country, not all of them. Well, you know, there's some literature which argues that by the time public spending goes to well above 35%, all sorts of disincentives begin to work their way into the system, you know. Spending becomes inefficient, the taxes become high, tax become complex, and therefore, you know, it's the countries that seem to perform quite well internationally. They have a level of spending about 30 to 35%. If you look at Australia, you look at Switzerland, you look at now at Finland, and a few other countries, Japan for that matter, and at least in terms of producing of socioeconomic indicators, not necessarily in terms of macroeconomic performance. So that deterioration is really worrisome, and is accompanied now with the public debt, as we have just heard. The public debt have increased substantially. You know, there is some literature from the fund from the past arguing that you can have a major crisis even at 40% of public debt. When Argentina got into its big problem in 2001, I don't think that the debt was much higher than 40%. But overnight, people were lending money to Argentina, lost confidence, and the interest rate went up by 2,000 basis points or so. So this is, again, a problem that need to face. Now, what to do? Well, clearly, they have to make some adjustment. And here we come to this interesting debate that has been going on in the past 3-4 years, you know, led by people like Krugman, also Larry Summers to some extent, and others that say, well, you have to keep the pump, priming the pump, because otherwise the economy will go into recession or will weaken. And for the sake of me, I find very little to agree with this argument. You know, I'm aware of many countries, you know, in a book that I just published 2-3 months ago with the Cambridge University Press. You know, there's a listing of countries that have cut spending dramatically. You know, take Sweden. Sweden in 1990, 1994 had 4 years of recession, 4 consecutive years, where the economy collapsed quite dramatically. They started making changes, they cut spending by an extremely large, people are not aware how much spending Sweden cut. We are talking about 15% of GDP. The same thing, by the way, was done by Canada. Canada was going through a very difficult period at one point in time, and the debt had reached 80-90%, inflation, etc. Then they started cutting. They cut spending by at least 10%. Finland did the same thing. New Zealand did the same thing. And in all cases, surprise, 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 instead of going into the recession, the country did very well. You know, there was always some little period of adjustment. But one thing which was important in all these cases was that the cut in spending and the cut in fiscal deficit, for that matter, was always accompanied by major structural changes. The structural changes compensate for whatever negative impact that might come from cutting spending. But this is one point that I want to make. The other point that I want to make is that, let me make a few comments about fiscal policy. We all learn the Keynesian story, recession, you have a country that's been doing okay, then at a certain moment, animal spirits weaken, or the Fed, or whatever, the equivalent, increase interest rate, and the country gets into a recession. You push the accelerator, and that's fine. Well, what are the two assumptions there? There are two really fundamental assumptions which are so obvious that I'm embarrassed to state them. But the point that what is obvious is very often is ignored, And the first assumption is the initial condition of a fiscal account is good. If you start with the zero debt, zero deficit, or even 20% debt and 1% deficit, and the condition is fine, by all means, there's no great danger in pushing the accelerator. But if you already start with the conditions where the deficit is very high, as it was, for example, in the United States, and the public debt is already high, as you say it is in Italy today, then under those circumstances, the effect that you should expect would be very different. So this is the first point. The second point in this Keynesian story is that really the assumption is that the economy does not have major imbalances, major structural changes. The whole economy has become weaker, and therefore you push the accelerator to multipliers work their way through the story. But the truth is that what we have had in the past 3-4 years were really fundamental imbalances. When the United States got into a recession, the saving rate in the US was at 0. The balance of payment was, they were running $600–700 billion per year. Is this a weakening of demand? How can we call this a weakening of demand under those circumstances? It's clearly that something fundamentally wrong was going on in the economy, and we know what was going on, the housing, the sector, etc. You still today, you have, I don't know how many millions of houses that cannot be sold, and so this is the problem. When you have these two conditions, major fundamental imbalances, in the balance of payment, in the financial sector, etc., and you have already initial conditions in the fiscal accounts which are not very good, don't hope that the fiscal expansion. That's why I had some difficulty this morning understanding what, in John's argument about Germany, what the Germans should do. Increase the fiscal deficit? How do you increase inflation in the north to compensate for the deflation in the south? I'm not sure how you do it except through a fiscal expansion. And if you already have a problem, then I'm not sure what comes out. So anyway, these are the major points. The other point that I want to make, maybe I have 2-3 more minutes, is a very large asymmetry in the Keynesian story. The assumption is that it's equally easy or equally difficult, you use whichever word you use, to cut taxes and increase spending than do the opposite. But this is clearly, it doesn't work this way. Look what is happening in Greece. You have asymmetry at the political level. Politicians are much happier to increase spending and cut taxes than do the opposite. You have asymmetry at civil service level. Very often they are the ones who have benefited from the fiscal expansion. And now in the case of Greece, you have the extreme case where the people in the Internal Revenue Service, in the tax administration, refuse to enforce the new tax law. So you have asymmetry in the street. I have never saw a demonstration against an increase in public spending or a cut in taxes, but I've seen many of the other. So when you put all these things together, you realize that there is no asymmetry in this. Once you begin to follow that road, let's facilitate a fiscal expansion, you know that going back will be very difficult. If I had time, I put together in in this little story I said in this paper, what kind of adjustment the country should do. And I don't know whether I can have 1 or 2 minutes.
You have, yeah, well, you have
okay,
2 more minutes.
1 minute. This, you know, when you start cutting, there are some stories that come out. You know, one is that one thing you have to learn, that there is less virtue to fiscal deficit than is generally assumed. I say that we should give more credit to Cicero, who was for balanced budget, than to Keynes, who was for unbalanced budget. Fiscal retrenchment should always be accompanied by well-thought-out structural changes. Don't just cut spending, you know, accompany it with major structural changes, because that compensates. Keep public spending below 35% of GDP. So once you go above 35%, unless you are Sweden, you know, you begin to have a problem. Consider the use of fiscal rules, although, you know, this is a controversial area, but if you can have fiscal rules, by all means, do not allow public debt to grow much above a relatively low level, say 40% of GDP. Favor expenditure cuts over tax increases, and this is the Alessina story, has been writing papers. In cutting expenditure, do not protect categories. This is always a mistake that we make. Let's protect investment, education. You should protect efficient expenditure. It doesn't matter in which category it appears. And there are inefficiencies in any category of public spending, investing, including investment. Worry about red tapes. They always create lots of problems. And one point which has been, and I will stop here, one point that has been bothering me very much is the role of complexity. I think that all our policies have become much too complex to understand them. I think we should choose simpler rules, simpler alternatives to very complex ones. Thank you very much.
Thank you, Vito. We didn't move from the first slide, but we still heard the whole story, and a very interesting one, as usually from you. Let me start on this panel in a different way. Let me first put maybe a couple of questions and then go to the audience to see what they have to ask. Well, one thing that interests me is I'm going to go to a different conference this afternoon in Vienna tomorrow morning with only bankers. And I'm going to talk to my Italian friends bankers. There are 2 Italians here at the panel. And what they're going to tell me about the fiscal situation in Italy, I already know. They're going to tell me, look, it's not a problem because, yes, the debt to GDP is 109%, but actually debt to wealth of Italy is 23%. And we can tax, and that's why you see the yield being so, you know, at par with Poland, as you would say, Darius. Although the debt levels are very, very different, plus you don't have a currency risk, etc. So what do you make out of that? I mean, and I connect that with the issue that was raised by you, Carlo, and Darius, that really the debt to GDP level is very different in terms when it's translated into market yields, depending on whether you're an emerging market country or you're a developed country. How much can we take really of that? What's taxable? How much you can really tax in the case of a need? Can we believe that? Is it government dependent? It's really a wealth dependent? So that's the first question. The second, let me put the second one also. There was also, in the morning, there was a lot of talk about the sovereign risk, you know, spreading to the banks. But we've also seen recently, during the recent crisis, the other way around, the banks spreading to the sovereign, increase in the public debt in the case of the Iceland, in the case of the Ireland, in the case of the Baltic countries. So suddenly something which looks like a perfect fiscal situation blows into a huge public debt to GDP ratio, not because of the problems with the fiscal policy in the first place, but because of the problems with the regulation and the financial sector policy. So it works both ways. So when we assess really the fiscal situation of the countries, should we actually look at financial sector policies as well? So maybe we can start with Carlo. You're
I mean, it would take me probably another 10 or 15 minutes to answer completely this question. They are very good questions. Let me start with the last one. Definitely the answer is yes. The financial sector risk, even if the government does not own banks and the financial sector, of course the financial sector risk is very important. However, I don't think that a country with a large financial sector should keep the debt to GDP ratio in a way, even lower. Ireland had 20%. Do we want to say that Ireland should keep zero or should have assets just because it has a large public financial sector? No, I think that when you have a problem like this, you have to avoid that the problem becomes a problem. When you have a financial sector this big, you need to make sure that it's properly regulated. In other words, that it does not become a threat for the public sector. There's no way you can keep the debt to GDP ratio so low. It would be like, okay, when you have, you don't keep a thermonuclear war weapon in your garden and then build protection around it. You just avoid keeping a thermonuclear war bomb in your garden. That's basically the idea. On the debt to GDP threshold, I think that, first of all, I want to clarify, we also have done our own work on the threshold, the debt threshold. We find a lower threshold. We find that above 40%, you start having negative impact on potential growth. Although it is statistically true that the effect becomes statistically relevant only at about 70, 80%, but in principle, the effect is lower, starts at a lower level. On this, I would also say that the ratio to GDP remains a critical one when you want to assess the solvency and meeting the intertemporal budget constraint. Because, I mean, it can be shown that if the real interest rate is larger than the growth rate of the economy, a stable debt to GDP ratio is mathematically equally to the no Ponzi game condition. You meet your intertemporal budget constraint. Ratios to wealth are relevant from another point of view. Again, from a portfolio choice point of view, it is important whether you are taking up 100% or 20% of the wealth of the private sector. One very last point, on the point, the data, whether it was revenue or spending, I don't know, but perhaps, Vito, you were looking at the ratios to GDP, and therefore, of course, in a recession, GDP drops and the spending to the GDP ratio goes up. But the fact is that what is causing the increase in the deficit is that there is a decline in GDP and you're losing revenues. That's maybe the difference between the two, the reading of the data.
Thanks. Darius?
Yes, thank you. On this last issue, I think this is another difference between the euro area and Central Europe, that actually part of the deficit in the euro area has been caused by the discretionary policies, of course, not only by falling revenues, but also to some extent by stimulus, by fiscal stimulus, including or plus the support to national banking systems, whereas that part of fiscal policy was practically non-existent during the crisis in Central Europe. So that was in Central Europe, that was mostly, I mean, the deficit was mostly a result of automatic stabilizers. Now on the issue of domestic, comparing Italy and Poland, or to what extent does it matter what's the structure of the debt? Of course, it does matter. I mean, what actually counts, what actually matters is the foreign debt in principle, right? As long as the debt is in the hands of citizens, then the government has always, theoretically at least, a possibility to tax citizens and always raise resources necessary to service the debt. So from that point of view, of course, Italy or Japan, for that matter, are in a better position, apart from the size of the debt itself. Nevertheless, what we observe here in the reaction of financial markets to the situation, to different situations in different countries, is a reflection of the existence of multiple equilibria. Italy was considered solvent by financial markets only 6 months ago. And only something happened in June, probably, a series of negative signals coming from different sides, among them also indecisiveness at the euro area level, political level, that produced this sudden loss of confidence in the markets. And then Italy, with its very high debt level, of course, became vulnerable and found itself under attack of financial markets. At this stage, still countries with much lower debt didn't suffer, but we cannot, in theory at least, exclude that these multiple equilibria can indeed locate themselves in different combinations of the debt level and the interest level on debt. Poland probably has this equilibrium at a much lower level, so of course we have to be particularly prudent on this score. Now on this issue of the risk coming from the sovereign to the financial sector and back, of course this is a two-way street. Absolutely, you're right. I was trying to. Well, first of all, we have to remember that the origins of the financial crisis in the euro area are different. I mean, there is a different fundamental reason for the Greek crisis, which has been simply excessive government borrowing, and in countries like Spain or Ireland, where in principle we had excessive private borrowing via domestic banks. But as we know, at the end of the day, this more or less ends up as a sovereign debt. Of course, we have to know the origins in order to know the remedies or to prescribe sufficient and proper remedies. But still, at the end, we have to deal with the sovereign debt crisis. We have this contagion going both ways, of course, and since we discussed the fiscal situation, so I was looking for reasons or for factors that would affect the fiscal situation, not the other way around.
Thank you. Vito?
Let me go to the question about Italy. You know, if you look at Italy, it has 120% public debt now. It has a fiscal deficit of about 4%, and it has huge assets, as you pointed out. You know, there are some estimates that Italy has about 3 times as a share of GDP public assets as the UK. You know, Italy is supposed to have about 120% also public assets. The UK is supposed to have about 40%. But what are the problems? So on this basis, Italy looks much better to me than the US. The US has a fiscal deficit of 9%. Public debt, now if you count everything, it's close to 120%. But what is the difference? Well, one is structural. You know, Italy has accumulated a lot of cholesterol in the institutional system that makes it very difficult for Italy to grow. And you know, the day before yesterday, Berlusconi was asked, what are you going to do about the structural reform? And he said, well, unfortunately, we don't have money. So the assumption that you could do structural reform only by spending. So that is a problem. You know, but coming back to the question of the assets, you know, the problem with the assets in Italy is that they are not owned by the Minister of Finance. They are owned by the army, they are owned by the regions, they are owned by municipalities. And giving the Italian legal system, you know, if the government wanted to force some of the region of to sell these assets, they would end up in the court, and the court battle would last 25 years, and that would be a fast solution. So that there are some assets they could sell. I mean, Eni, for example, the government has a lot of assets in Eni, and that's something that, but then if they sell Eni, then the tax that they get out of the revenue in the future, you know, is a quick fix, but doesn't solve the problem. So that is the difficulty.
Thank you. Well, didn't realize there is a difference in nowadays Italy between the government and the army, but if you say so, it's a bit worrying, so I must say. Okay, but, yeah, Carlo, go for quickly.
An interesting point that why Italy is different from the US, or why the US is different from any other country. I think that we don't understand why the US is different if we don't bring in the reserve. The role of the dollar as a reserve currency. At the moment, if you look at the composition, who holds the debt issued by the federal government, 34% is held by foreign central bank. Another 18% is held by the Fed. So the share that is actually sold on the market to the private sector is only 48% of the entire debt. Of this, only 14% goes to the most volatile component of the investors, which is the private foreign sector, only 14%. This is compares with, and of course, Japan has only 3% because it's mostly domestic, the domestic financial sector. This is a key variable. If you regress, you just take the euro area countries and you regress the spread over Germany. You take the euro area countries plus Japan and the US. So you end up with, taking into account data constraints, something like 17 observations. You regress this just on 3 variables: the level of the debt ratio, the level of the deficit ratio, and the third variable is the share of your debt that is held by the foreign private sector. With these 3 variables, you get an R-square of 72%, which is hard to beat in a cross-section. This, the composition of how much is held by the foreign private sector, I think, is a critical variable. And in the US, it's only 14% because 34% is held by foreign central banks.
Okay. Thanks. Well, at the risk that I'm going to be late for a plane, I'll allow for one more question, if there is one at this point from the public. If not, that bodes well for my travel arrangement. Thank you very much. I think there is one.
Question.
There is one.
The
Yes.
only one. My name is Barbara Hamot. I'm from Warsaw School of Economics. I would like to add 2 points to those presentations. Firstly, we forgot about the factor that is the time structure of the public debt, which is very important because if we are looking into the data on the fastly maturing public debt, then we have a very bad projection because for many countries from the euro area, the huge amount of the public debt, like 20%, 15%, something like this, must be paid back within the next year, 2 years, or next 3 years. It is very hard just to make the projection presently that this fiscal consolidation will be possible just to be realized. So it is the one risk factor. The second risk factor is the theory, and I would like to comment this presentation on Professor Vittor Tanzi. We forgot, I think that we need, firstly, just to understand that in the dimension of creating the fiscal deficit, the most important is the fact to be sure what is the output gap presently in our economy. If we cover much more than those lost opportunities, it means that it is unreal just to pay back. So this playing with the time for paying back this debt in the future will be vastly dependent and very dependent if the structural change of economy will be able to affect this output gap or to change this level or the size of the output gap. So it's only my suggestion. Thank you very much.
Could we go very quickly, just a couple of minutes? Yeah. Vittor.
Let me just quickly, first of all, going back to the point I made, the distinction between a Keynesian type of recession and a structural type of imbalances. When you have major imbalances, the concept of potential output becomes very uncertain. And all the estimates that I see, to me are meaningless because I don't know what it means. 5 million people lost their jobs building houses in Arizona. Pumping money in Massachusetts in the health sector, it's not going to make these people move. So what has happened to the potential output? That I think is a very, very important consideration.
Okay, thanks. And quickly,
just very briefly, the maturity structure of debt is important. It's not the only thing. We have to remember that the country with the second longest maturity before the crisis in the euro area was Greece. So.
Okay. Thank you very much. Thank you.